Welcome to the Basic Financial Analysis, Ratios and Performance Monitoring in Microfinance Banks. This is Part 2, Lecture 6 of the topic. In our last lecture, which was Lecture 5, we discussed ratio analysis. Today, we are discussing the cash flow statement. Cash flow in microfinancing is very important for any business to services. Remember, we are still discussing the customer's account books and not the bank's. Customers have their own cash flow statement difference from what the banks use. It is very important for microfinance institutions to understand the metrics of their customers' business. Let's begin. Our topic for Lecture 6 is Cash Flow Statement. Before we start, I recommend you subscribe to our channel at Microfinance Arena. We have some microfinance template we would be dropping in the description box below. These templates come very handy for microfinance professionals. We would be making these available in our subscribed member section. You can also request for templates used for microfinance operations as a subscribed member. And now I ask, what is the cash flow statement? A cash flow statement shows the amount of cash and cash flow equivalents that goes in and out of a client's business. This is one of the most important credit analyses that a microfinance institution must understand if loan is to be granted to the client. A well-structured cash flow will give a clear detail of the amount that comes into the client's business. Let's talk about the cash flow components. The cash flow components comprises of three major stages that makes up a client's cash flow statement. We have the inflow, the outflow and the net cash flow. First, we discuss about the inflow. This represent all incoming values which ultimately result in increase of liquidity for the client's business over the stated period. Items in the components included cash receipt from customer, loans, either formal or informal, income from other sources, cash receivables from customer, family member salaries. The next we will be looking at in the components is the outflow. This represent all outgoing values which ultimately result in decrease of liquidity for the client's business over the stated period. Items found in the components include monthly rent, monthly loan repayments, purchases, wages, salary, utility payments, monthly private facility expenses. The final on the list is the net cash flow. This is the amount of cash gained or lost by a business over a specific period. We calculate it by deducting total cash outflows from total cash inflows. Let's look at the cash flow items. These are items that are found in the client's cash flow. They are grouped into inflow and outflow items. Under the inflow items we have sales, loans, receivables. Under the outflow items we have salaries, loan repayment, utilities, rents and other expenses. In this course, it's not just enough to know the definition of a cash flow. It is good we know the importance of the cash flow statement. Most especially when it concerns customers we would be granting loan to. This would take us the importance of a positive cash flow. Your customers can have goods in their shops for sale. When they cannot easily convert them to cash, then it becomes a problem for the business. Let's look at what a positive cash flow can do. 1. There is increase in the liquidity of the client's business. 2. Debt settling is made easy. 3. Enhances reinvestment of funds. 4. Enhances return on investment to business owner. Imagine having to properly manage your resources all because you understand how a cash flow works. Before we round up, we would be looking at this sample customer's cash flow statement template. This template is very easy to use and well articulated for your customer's cash flow analysis. Remember to subscribe so you'll continue to get instant notification from Microfinance Arena. You can also drop your comments in the comments link below. Let's go back to our sample cash flow statement. A typical micro client's cash flow statement over a certain period takes the below form. This is a simple 6-month customer cash flow statement with a total column at the end. It highlights the inflow, outflow and net column. The column for the inflow section will be populated with all values that increases liquidity for the business. The column for the outflow section will be populated with all values that decreases liquidity for the business. The column for the net cash flow section will be populated with the remaining value after subtracting the outflow from the inflow. The extended table below the net cash flow we will be seeing in the sample exercise below shows the balances at the beginning and the end of each preceding months. For better understanding, let's take this sample exercise to better understand how our customer's cash flow works. A client record shows that she collected a loan of $300,000 in April 2018, with a loan repayment of $25,000 monthly. From January to June, she pays utility of $4,000 for her shop, $1,000 each as salary for her 5 staff and $5,000 for rent monthly. She was expecting $10,000 for goods supplied last year in 2017, which she eventually received in January 2018. From January to June, she made monthly sales of $20,000, $15,000, $25,000, $30,000, $33,000 and $40,000 respectively. She receives extra cash of $10,000 from her husband as support. While this concludes our lecture for Lecture 5. Compute the customer's cash flow below. Just follow the examples below and you'll understand where each item is placed.